Friends, thank you for being here today. What if I told you that Canada's entire banking system has an expiration date, not a metaphorical one, a literal legal deadline hardwired into the law itself? June 30th, 2026, less than 150 days from now, a date after which the big six banks could technically lose their legal authorization to operate on Canadian soil. This sounds insane, but the data is unambiguous. Buried in Section 21.1 of the Bank Act sits what financial lawyers call the sunset provision. It states explicitly that banks shall not carry on business in Canada after June 30th without parliamentary extension. Not, may not, shall not. This is the mechanism hiding in plain sight, and in a period of extreme political gridlock, trade war chaos, and a fractured parliament, this is no longer just a formality. This is a structural fault line. Here's the part nobody expects. This clause has been sitting there since 1992. Every few years, Parliament is forced to renew it, and every time they have. But this time is different. We are not operating in normal conditions. We are facing a convergence of political paralysis, minority government dysfunction, and the most aggressive trade dispute in a generation. The simple logic does not apply here. Let me be precise. The global debt edifice stands at $315 trillion. Canada's banking sector holds over $6 trillion in assets under management. These are not theoretical numbers. These institutions control mortgage markets, pension flows, and the liquidity arteries of an entire nation. And all of it rests on a legal framework that technically expires in less than 5 months. This is vanishing in real time. Now, I know what you're thinking. Parliament will just renew it, right? They always do. That is normalcy bias talking. Human beings are hardwired to believe tomorrow will look like yesterday. But let me show you what actually happened the last time this clause came up for renewal under political stress. In 2013, Canada operated under a minority government. The renewal process dragged for months. Financial institutions had to prepare contingency frameworks. Legal teams drafted emergency resolutions. Markets became jittery, and that was during peacetime. We are not in peacetime anymore. Right now, Canada faces the most volatile trade environment since NAFTA's inception. Tariff threats from the United States, supply chain fractures, a prime minister under siege from his own party, a parliament so divided that basic legislation stalls for weeks, and you want to assume they will seamlessly renew the legal authorization for the entire banking sector before the deadline. This is not theoretical, it is observable. But that's not the real problem, because what comes next is worse. Let me take you back to why this clause exists in the first place. In 1992, Parliament introduced the sunset provision as a governance tool. The stated goal was to force periodic review of financial regulation, modernization, they called it, a way to ensure banks operate under current policy priorities. Think of it like a mortgage, but instead of a homeowner refinancing every 5 years, it's the government deciding whether the entire banking system gets to continue existing. Why go through this elaborate charade? The answer is discipline. Parliament wanted leverage over the financial sector. They wanted to ensure that every few years, banks would have to come to the table and renegotiate the rules, capital requirements, foreign ownership limits, competition policy, lending standards. All of it becomes negotiable when the authorization itself is on the line. This is where the first domino falls, because what happens when Parliament can't agree? What happens when the renewal process becomes a hostage situation? We are about to find out. Let's cut through the noise. The Bank Act doesn't just cover the big six. It covers the entire regulatory scaffold that holds the financial system together. credit unions, foreign bank subsidiaries, trust companies, insurance entities. Every institution operating under federal financial authority answers to this act, and all of it sunsets on June 30th. Now, the official position is that this is procedural, low risk, a formality. The Department of Finance will tell you that courts would never interpret expiry as immediate illegality, that OSFI, the banking regulator, would maintain supervisory authority during any transition, that emergency legislation could be passed in days if required, and technically they are correct. But here's what they're not telling you. Markets don't care about technical correctness. Markets care about ambiguity. And right now, we are staring at the largest legal ambiguity in Canadian financial history. This is the crack that becomes an earthquake. Let me show you what I mean. Bond markets are called the vigilantes for a reason. They punish uncertainty. And what do you think happens when institutional investors realize that the legal framework underpinning $6 trillion in banking assets has a 90-day countdown clock? They don't wait for disaster. They reprice risk immediately. Canadian bank stocks have already begun showing stress fractures. Royal Bank's price-to-book ratio has compressed. Toronto Dominion is under regulatory siege in the United States. Bank of Nova Scotia is hemorrhaging market share in Latin America. These are not unrelated events. This is liquidity draining from a system that suddenly looks fragile, and this part has already begun. Now, you might say, Parliament has renewed this clause every single time since the 90s. Why would this time be different? Let me give you 3 reasons. First, minority government. Justin Trudeau's Liberals do not control Parliament. They need opposition votes to pass anything, and the Conservatives, led by Pierre Poilievre, have zero incentive to make Trudeau's life easier. Every piece of legislation becomes a negotiation. Every vote becomes leverage. Do you really think they will fast-track banking renewal with an election looming? Second, trade war. Canada is caught in the crossfire of U.S. tariff threats. Supply chains are fracturing, business confidence is collapsing, and the legislative calendar is jammed with emergency trade measures. Banking renewal is not the priority, it's a footnote. Third, public anger. Canadians are furious at their banks. Mortgage rates have exploded, credit card debt is at record highs, fees are astronomical. The last thing any politician wants to do right now is publicly defend the Big Six. Renewal becomes politically toxic. This is where everything changes. So what happens if June 30th arrives and Parliament hasn't passed the renewal? Let's game this out. The Bank Act expires. Technically, banks lose their statutory authorization to operate, but they don't just shut down. That would be economic suicide. Instead, we enter a gray zone, a legal limbo where institutions continue functioning under emergency protocols while lawyers and regulators scramble to patch the framework. But markets don't wait for patches, they smell blood. Here's what that looks like on the ground. Institutional investors begin pulling capital from Canadian bank bonds. Credit default swaps spike. Borrowing costs for the Big Six increase. Mortgage rates rise further. Consumer confidence collapses. And suddenly, what was a procedural issue becomes a liquidity crisis. For the average household, this means one thing. Your mortgage just got more expensive. Your savings account is worth less. Your pension is under pressure because the system that promised stability has a structural expiration date and nobody is fixing it. This is the moment the clock actually starts. Now, let me be clear. This is not a conspiracy. This is stated policy. The sunset provision is public. Section 21.1 of the Bank Act. You can read it yourself. The deadline is real. The risk is observable. The question is not whether the clause exists. The question is whether Parliament will act before the system breaks. And we haven't even reached the breaking point yet, because here's the detail even analysts tend to miss. The sunset clause doesn't just cover banks, it also covers the Insurance Companies Act and the Trust and Loan Companies Act. Same mechanism, same deadline, June 30th. That means life insurance policies, pension funds, trust accounts, all operating under the same legal framework that is about to expire. This is the system's most crucial secret, which we will explore later. But first, we need to understand how we got here, because the Bank Act Sunset Clause is not an accident. It is the final act of a long tragedy, a story that begins not in Ottawa, but in the ashes of the early 1990s financial crisis. In 1992, Canada was emerging from the worst financial crisis since the Great Depression. Real estate had collapsed. Trust companies were failing. The government had just bailed out multiple institutions, and regulators realized they had a problem. The financial system had grown faster than the laws governing it. Banks were operating under rules written in the 1960s, outdated, fragile, dangerous. So Parliament made a decision. They would rewrite the Bank Act. But instead of creating permanent legislation, they built in a kill switch. The sunset provision. Every 5 to 7 years, the entire act would expire unless Parliament actively chose to renew it. This was revolutionary. It meant banks could never again operate without ongoing political approval. The authorization wasn't permanent, it was conditional. Here's the part they never put in the official reports. This mechanism was designed as leverage, a way to force banks to the negotiating table whenever Parliament wanted policy changes. Capital requirements too low, threaten not to renew, foreign ownership limits too restrictive, make it part of the renewal debate. The Sunset Clause turned banking regulation into a perpetual hostage negotiation, and for 30 years it worked until now. Because what happens when the hostage takers can't agree among themselves? What happens when Parliament itself becomes the crisis? Let me show you the timeline. The last renewal happened in 2021. 5-year extension, routine process, passed with minimal debate, but that was during COVID. Governments had emergency powers. Consensus was easy. Nobody wanted to rock the boat during a pandemic. Fast forward to today. COVID emergency powers are gone. Consensus has evaporated, and the political landscape looks nothing like 2021. This is where the cascade becomes unstoppable. Right now, Justin Trudeau is fighting for his political life. His approval ratings are in free fall. His own MPs are calling for him to resign. The NDP, his coalition partner, just pulled support. The Conservatives are surging in polls, and every piece of legislation turns into a battle. Immigration reform, stalled. Climate policy, gutted. Budget measures, delayed for months. And you think banking renewal is going to sail through? Let's talk about what actually moves markets. Certainty. Institutions need to know the rules will be the same tomorrow as they are today. They need legal continuity. When that certainty vanishes, capital flees. And right now, certainty around Canadian banking is vanishing in real time. Here's the forensic evidence. In January, Royal Bank quietly shifted $2 billion in liquid assets to U.S. subsidiaries. Not a massive move, but unusual. Then Toronto Dominion announced it was pausing expansion plans in Canada, redirecting capital to American markets. Bank of Montreal restructured its derivative book to reduce Canadian exposure. These are not random decisions. These are institutions preparing for instability. The canaries are dying in the coal mine. But that's not even the part that scares me, because the real threat isn't what banks are doing, it's what the bond market is pricing in. Canadian government bonds have started behaving strangely. The yield curve is inverting at the long end. 10-year yields are rising faster than 30-year yields. That's not normal. That's the market saying it trusts Canada less in the medium term than the long term. Why? Because June 30th sits right in the middle of that medium-term window. And bond traders are smart. They see the sunset deadline. They see the political gridlock. and they're repricing risk accordingly. This part isn't a prediction, it's math. Now, let me take you deeper. The Bank Act renewal isn't just about whether banks can operate, it's about what terms they operate under. And this is where things get interesting because renewal always comes with conditions. In 2021, Parliament added new climate disclosure requirements. In 2017, they tightened mortgage stress tests. In 2012, they changed capital adequacy ratios. Every renewal is a negotiation, and this time the demands are massive. The conservatives want to break up the big six oligopoly, introduce more competition, lower fees. The NDP wants to nationalize payment systems, force banks to cap credit card interest rates. The Greens want strict climate-related lending restrictions. And the Liberals, they just want to survive until the next election. These positions are irreconcilable, and the deadline is 130 days away. So here's what's really happening. We are watching a game of chicken between political factions using the banking system as the hostage. Conservatives know they can use renewal to embarrass Trudeau, make him choose between defending unpopular banks or letting the deadline pass. The NDP sees it as leverage to extract policy concessions, and Trudeau is trapped. He can't renew without opposition votes, but he can't afford to let the system enter legal limbo. The domino is already tipping. Let me show you what this looks like in practice. Last month, the House of Commons Finance Committee held hearings on banking sector reform. Should have been routine. Instead, it turned into a circus. Conservative MPs grilled bank CEOs about profits and executive compensation. NDP members demanded caps on mortgage rates. Liberal committee members tried to change the subject. And at the end, no progress, no consensus, no timeline for renewal. The hearing adjourned with the sunset deadline unmentioned. This is a default in all but name. Now let's talk about what the average Canadian should be watching for, because the collapse won't announce itself with sirens and flashing lights. It will be subtle, incremental, a series of small failures that suddenly compound into systemic crisis. First signal, credit spreads. Watch the difference between what banks pay to borrow and what the government pays. That spread is widening, slowly but consistently. That means the market trusts banks less than it did 6 months ago. Second signal, interbank lending rates. When banks stop trusting each other, they charge more to lend overnight. Canadian interbank rates have been creeping up, not spiking, just drifting higher. That's fear entering the system. Third signal, foreign exchange volatility. The Canadian dollar has been weakening against the US dollar. Part of that is commodity prices, but part of it is capital flight. Investors are quietly moving money south of the border, just in case. These are not coincidences, these are warnings. And here's where it gets worse, because even if Parliament does renew the Bank Act, the damage may already be done. Markets have long memories. Once institutional investors realize that Canadian banks operate under a framework that can expire, they will demand higher returns to compensate for that risk permanently. This is the part where common sense actually becomes your enemy. You might think, well, if it's such a big risk, why aren't banks screaming about it? Good question. And the answer is simple. They can't. Because the moment bank CEOs publicly acknowledge the sunset risk, they trigger the very panic they're trying to avoid. So instead, they stay quiet, issue bland statements about confidence in the legislative process, and hope nobody notices the deadline approaching, but we notice, and the bond market notices, and institutional investors notice. The liquidity tide is going out, and we are about to find out who is swimming naked. Let me give you a specific example of how this plays out. In 2008, Lehman Brothers had a similar problem. Not a sunset clause, but a funding cliff. They had short-term debt maturing faster than they could refinance it. Everyone knew it, but nobody wanted to be the first to say it out loud. So the market pretended everything was fine until September 15th, when it wasn't. Lehman collapsed, not because they were insolvent, but because confidence evaporated overnight. Canada's banks are not Lehman, but the mechanism is the same. Confidence is binary. It exists until it doesn't. And right now, the sunset clause is a loaded gun pointed at confidence. We don't have months. This is happening in days. Now, some people will tell you this is fear-mongering, that Canada has institutional safeguards, that the courts would intervene, that emergency legislation would pass. And they might be right in a normal environment, but we are not in a normal environment. We are in a trade war with our largest trading partner. We have a government on the brink of collapse. We have inflation still running hot. We have mortgage default rates climbing. We have commercial real estate imploding. And on top of all that, we have a legal framework for the banking system that expires in less than 5 months. This is a convergence, and convergences are where systems break. Because here's what nobody wants to admit. The Canadian economy is a leveraged bet on real estate and resource extraction. Housing prices are inflated beyond recognition. Household debt to income ratios are the highest in the G7. And all of it is financed by banks operating under a legal framework that might not exist after June. What happens to your mortgage if the bank holding it loses legal authorization? That's not a rhetorical question. That's the nightmare scenario keeping financial lawyers awake at night. Let me be clear about what we're facing. This is not one crisis. This is a trifecta, 3 distinct forces hitting simultaneously. First, the structural break. The Bank Act expires June 30th. Parliament shows no signs of moving toward renewal. The legislative calendar is jammed. Political will is non-existent. That's the structural fault line. Second, the domestic liquidity crisis. Canadian banks are already under pressure. Mortgage stress, commercial real estate deterioration, rising loan loss provisions, credit quality declining. The system was fragile before the sunset deadline appeared on the horizon. Now it's critical. Third, the sovereign debt spiral. Canada's federal debt has exploded. Provincial debt is worse. Interest payments are consuming larger portions of tax revenue, and the government needs banks to keep buying bonds. But what happens when banks themselves become questionable entities after June 30th? Who finances the deficit then? This is the convergence we talked about earlier. And convergences don't resolve themselves. They accelerate until something breaks. Now, here's the psychological trap you need to avoid. It's called normalcy bias. The human brain is hardwired to believe that tomorrow will look like yesterday, that systems which have always worked will continue working, that responsible adults are in charge and will fix problems before they become catastrophic. This is the lie your mind tells you to avoid panic. But let me show you what history actually teaches. Every major financial crisis was preceded by widespread normalcy bias. In 2007, people believed housing prices couldn't fall nationally. In 2001, people believed the internet boom was sustainable. In 1929, people believed the market would keep rising forever. The pattern is always the same: obvious warning signs, experts dismissing concerns, the majority assuming someone else will fix it, and then overnight the assumption shatters. We are in that assumption phase right now. The Canadian government assumes Parliament will eventually renew the Bank Act. Banks assume markets will stay calm. Households assume their deposits are safe. Everyone assumes the system is too big to fail, but here's what they're missing. Failure doesn't require insolvency. Failure only requires loss of confidence, and confidence in Canadian banking is already cracking. Let me show you the mechanics of how this unravels. It starts small. A few institutional investors quietly reduce exposure to Canadian bank bonds. Nothing dramatic, just portfolio rebalancing. But then others notice credit spreads widen slightly, borrowing costs for banks tick up, margins compress, profitability falls. At first, banks absorb the pressure. They have capital buffers, liquidity reserves. But as June 30th approaches and Parliament still hasn't acted, the pressure intensifies. More investors exit, spreads widen further, and suddenly we hit a threshold. Banks have to choose. Do they raise deposit rates to retain customers? That kills profitability. Do they raise lending rates to maintain margins? That crashes the housing market. Do they shrink their balance sheets? That triggers a credit crunch. There is no good option, only varying degrees of pain. This is the moment small businesses get crushed, because when banks tighten lending, the first casualties are always the most vulnerable. Small business lines of credit get pulled, mortgage renewals get denied, credit card limits get slashed, and families who were already stretched thin suddenly find themselves with no safety net. For pensions, this is catastrophic. Canadian pension funds hold massive positions in domestic bank stocks and bonds. CPP, Ontario Teachers, OMERS, all heavily exposed. When bank valuations fall, pension solvency ratios deteriorate, contribution requirements rise, benefit payments get questioned. Retirees who thought they were secure suddenly aren't. This is what systemic risk actually means. It's not just banks failing, it's the entire web of financial relationships unraveling simultaneously. And here's the part nobody is talking about. Even if Parliament does renew the Bank Act in June, we might already be past the point of no return. Because once the market recognizes that Canadian banks operate under a framework that can expire, that risk gets permanently priced in. Think about it. Why would international investors accept the same yields on Canadian bank bonds as American bank bonds when Canadian institutions have an embedded sunset risk? They won't. They'll demand a premium, and that premium becomes a permanent tax on the Canadian financial system. This is how you lose reserve currency status without even realizing it. Now, let's talk about what you can't do. You can't stop this. You can't vote it away. You can't protest it into submission. The gears are already turning. The timeline is set. June 30th is coming, whether we like it or not. But you can prepare. And preparation is the difference between surviving and drowning. So here's the binary choice you face. Do you own assets or do you own claims on assets? Let me explain the difference. When you hold a stock, you own a claim on future earnings. When you hold a bond, you own a claim on future payments. When you hold a bank deposit, you own a claim on the bank's promise to pay you back. All of these are paper. All of these depend on institutional continuity. All of these evaporate if confidence collapses. But when you own gold, you own metal. When you own land, you own dirt. When you own physical assets, you own reality. Not promises, not claims, reality. This is stepping out of the line of fire. Now, I'm not saying sell everything and buy gold bars tomorrow. That would be irrational. But I am saying that the composition of your assets matters a lot. And right now, most Canadians are catastrophically overexposed to paper claims on institutions that might not have legal authorization to exist in 4 months. Think about your portfolio, stocks, claims on corporate earnings dependent on banking liquidity, bonds, claims on government payments dependent on banks buying debt, mutual funds, claims on fund managers who hold claims on other paper assets, ETFs. Same thing, just packaged differently. It's claims all the way down. And what happens when the legal framework underpinning those claims becomes questionable? The claims lose value, not because the underlying assets disappeared, but because the mechanism for honoring claims broke. This is the money illusion. You become a millionaire on paper, but poorer at the grocery store. So, what does preparation actually look like? It means reducing exposure to Canadian banking system risk. It means holding assets that don't depend on legal continuity. It means diversifying across jurisdictions so you're not entirely dependent on Parliament solving its problems. Practically, that might mean holding some physical precious metals, not as an investment, as insurance. It might mean keeping some liquidity in US dollar accounts, not because you don't trust Canada, but because you don't trust the timeline. It might mean paying down variable rate debt before renewal uncertainty hits mortgage rates again. These are not radical steps. These are basic risk management principles. But here's what you absolutely need to understand. The window for preparation is closing, not in months, in weeks, because once the broader market wakes up to the sunset risk, asset prices will adjust violently. Gold will gap up. The Canadian dollar will gap down. Bank stocks will crater. And if you haven't prepared, you'll be forced to make decisions in the middle of chaos. And decisions made in chaos are always the wrong decisions. Let me give you the timeline. We are currently in early February. Parliament returns from recess mid-month. The legislative calendar is packed through March with budget debates and trade war emergency measures. That leaves April and May for banking renewal. 2 months, 60 days to negotiate, draft, debate, and pass legislation that hasn't even been introduced yet. Does that sound like enough time to you? Because it doesn't sound like enough time to the bond market. It doesn't sound like enough time to institutional investors. And it definitely doesn't sound like enough time to me. This is where the countdown quietly began. Now, some of you are thinking, but won't the government just pass emergency legislation if we get close to the deadline? Maybe. Emergency legislation is possible. Cabinet has authority to introduce interim measures. But emergency legislation is exactly that: emergency, temporary, fragile. And markets hate fragile. Even if emergency legislation keeps banks operating past June 30th, it doesn't solve the underlying problem. It just delays it. And delay means prolonged uncertainty, which means elevated risk premiums, which means higher borrowing costs, which means economic contraction. There is no painless path from here. So let me close with this. We are not facing a traditional financial crisis. We are facing a legal crisis that becomes a financial crisis. The mechanism is different, but the outcome is the same: loss of confidence, capital flight, liquidity evaporation, system stress. The only question is whether you see it coming. Most people won't. They will assume normalcy until the moment it shatters. They will trust that someone else is handling it. They will wait for mainstream media to sound the alarm. And by the time that happens, it will be too late to prepare. But you're here. You're listening, which means you have a choice. You can acknowledge the structural reality and adjust accordingly, or you can hope that Parliament suddenly becomes competent and decisive. One of those is a strategy. The other is a prayer. History favors the prepared, and the window for preparation is closing. June 30th is not a maybe. It's a certainty. The only uncertainty is whether Parliament acts before the system breaks. And based on everything we've seen, everything we know about political dysfunction and legislative gridlock, betting on competence feels like the riskiest bet of all. So prepare, diversify, reduce paper exposure, hold real assets, and watch the calendar, because this time the deadline is real, the risk is observable, and the clock is ticking. Friends, thank you for being here today.